Hey guys, welcome back to Trader's Map. Today, I'm going to walk you through mastering the profitable day trading strategy, Larry Williams' Descent, EMA and ICT FVG. First, let's start by looking at the big picture. The goal of today's strategy is to help you trade more effectively and profitably. The Larry Williams Descent EMA strategy focuses on using moving averages to identify the right entry points. It's simple but powerful. The ICT FVG, fair value gap, helps us spot areas where price could move strongly, giving us even more opportunities to profit. Before we dive into the details, let's quickly review our last strategy. Understanding the foundation of our previous approach will make it easier to connect the dots and see how this new strategy can take your day trading to the next level. Let's quickly review our previous last strategy. Confirm the trend using the 12 and 50 EMA on the 15-minute chart. Spot overbought or oversold levels with the Williams Descent R indicator. Switch to the 5-minute chart and wait for a structure shift. Enter the trade when the breakdown happens and manage it with a 1-3 risk-reward ratio. So let's break down today's strategy in detail. First, we'll talk about the key components that make this strategy so effective. What is EMA? The exponential moving average, EMA, is a powerful trend-following indicator that smooths out price action by giving more weight to recent prices. This makes it more sensitive to price changes compared to the simple moving average. In our strategy, we use two key EMAs, the 12 EMA and the 50 EMA. The 12 EMA reacts quickly to price movements, helping us track short-term trends and potential entry points. The 50 EMA, on the other hand, gives us a broader perspective of the market's direction, showing the overall trend and acting as dynamic support or resistance. By using both EMAs together, we can confirm the market trend and identify when price is likely to reverse or continue. The crossover of the 12 EMA over the 50 EMA often signals a potential buy, while a crossover below may signal a sell. This combination allows us to make informed, profitable trading decisions. What is Williams Descent R? The Williams Descent R is a momentum indicator that helps traders identify overbought and oversold conditions in the market. Developed by Larry Williams, it measures the current closing price relative to the highest high over a specific period, usually 14 periods. The indicator is displayed on a scale from 0 to -100. A reading above -20 indicates an overbought condition, suggesting that the asset might be due for a price reversal to the downside. A reading below 80 signals an oversold condition, indicating that the price could be ready for a bounce or reversal to the upside. Why is Williams Descent R useful? It helps traders spot potential turning points in the market by showing when price may be overextended. When used in combination with other indicators, like the EMA and FVG, it gives us a clearer picture of when to enter or exit a trade. For example, if the price is oversold below -80 and the trend is bullish, we might look for a buying opportunity when Williams Descent R crosses back above -80, signaling that the market could be ready to reverse. What is FVG, fair value gap? The fair value gap, FVG, is an important concept in market analysis, especially within the ICT inner circle trader framework. It occurs when price moves too quickly in one direction, creating an imbalance in the market. This leaves behind an unfilled gap between the current price and previous price action. Essentially, the market hasn't fully tested or processed the price levels in this gap, creating a potential opportunity for traders. In simple terms, an FVG is a region where price has moved sharply, leaving a gap between two price levels. This often happens during periods of high volatility or news events, where price quickly shifts and leaves behind a void. How does FVG work in trading? The general idea is that price tends to revisit these gaps to fill them. When the market moves back into the FVG, it often acts as a key support or resistance level. Traders look for price to return to these gaps to confirm trade entries or exits. In our strategy, we'll use FVG as one of the factors to identify potential areas where price may move strongly, either to continue the trend or reverse. While it's not the only tool, combining it with other indicators like the EMA and Williams Descent R helps us find high probability trade setups. Why is FVG important? FVGs provide valuable insights into market inefficiencies, helping us identify price levels that could act as turning points. By recognizing these gaps, we can time our entries more effectively and improve our chances of capturing profitable moves. When used with other tools like the EMA and Williams Descent R, FVGs help create a more robust strategy for day trading. This is my simple strategy to become a profitable trader in 2025. Let's break it down step by step to show how this strategy can help you achieve consistent profitability in trading. Use EMA to confirm the trend. The 12 EMA and 50 EMA are your tools to identify the overall market trend. If the 12 EMA is above the 50 EMA, it signals a bullish trend. If the 12 EMA is below the 50 EMA, it signals a bearish trend. FVG for 4H liquidity zones, fair value gaps, FVGs on the 4-hour chart, highlight areas of liquidity where price might revisit before continuing its trend. These gaps are like magnets for price as the market often returns to fill them. Spotting these zones ensures that you're trading in areas where price action is likely to react strongly. Check Williams R for extreme levels. Use the Williams R indicator to confirm overbought or oversold conditions. Overbought levels, above -20, signal that price might reverse down. Oversold levels, below -80, suggest that price could reverse up. Look for swing liquidity on the 15-minute chart. On the 15-minute chart, focus on price taking out swing liquidity. This occurs when price breaks previous highs or lows to trap traders. These moves often signal that the market is preparing for a reversal, giving you a key entry signal. Confirm reversal points on the 5-minute chart. Once you identify a potential reversal on the 15-minute chart, switch to the 5-minute chart to confirm the reversal. Look for market structure shifts such as a break in trend or a key price level being reclaimed. This ensures precise timing for your trade entries. Set your stop loss. Place your stop loss just below or above the 5-minute short-term swings, depending on whether the setup is bullish or bearish. This minimizes your risk while allowing the trade room to breathe. Risk management. Risk 1% of your account balance per trade. This disciplined approach protects your capital and ensures you can survive losing streaks. Aim for a 1-to-3 risk-reward ratio. Target 3 times your risk for every trade. For example, if you risk $100, aim to make $300. This ratio ensures that even with a lower win rate, you remain consistently profitable over time. By following this strategy, you're combining trend confirmation, liquidity zones, reversal points, and disciplined risk management into a powerful, straightforward approach. Stick to the rules and you're set to achieve profitability in 2025. Let's dive deeper into how this strategy works step by step. I'll guide you through bullish and bearish examples so you can see how each part fits together to create consistent, profitable trades. Bullish example, GBP-JPY on December 16th. Step 1. Confirm the trend using 12 EMA and 50 EMA, 50-minute chart. At around 3 a.m. New York time, we started by checking the trend on the 15-minute chart. The 12 EMA was above the 50 EMA, confirming a bullish trend. This told us to only look for buying opportunities, as trading with the trend increases the chances of success. Step 2. Identify fair value gaps, FVG, on the 4-hour chart. Next, we move to the 4-hour chart to spot fair value gaps, FVGs. An FVG formed, marking an area where price might return before continuing upward. FVGs act like magnets, attracting price to fill the gap. This helped us identify a strong liquidity zone where buyers could step in. Step 3. Analyze liquidity zones on the 1-hour or 15-minute chart. We then zoomed in to the 15-minute chart to see how price interacted with the FVG. The FVG created a liquidity zone, and we waited for price to take out a short-term low. This is known as a liquidity grab, where the market traps sellers by dipping below a recent low before reversing. Step 4. Use Williams R to confirm oversold levels. Once liquidity was taken, we used the Williams R indicator to confirm oversold conditions. The indicator dropped below this 80, signaling that price was in an oversold zone and might reverse upward. This confirmation added confidence to our setup. Step 5. Look for market structure shift on the 5-minute chart. We then moved to the 5-minute chart to pinpoint the best entry. A market structure shift occurred when price broke above a key resistance level. This shift confirmed that the bullish trend was resuming, and it was the perfect time to enter the trade. Step 6. Enter the trade and set a stop loss. We placed our entry as soon as the market structure shifted. The stop loss was set just below the most recent 5-minute swing low to minimize risk. Our target was a 1-3 risk-reward ratio, meaning for every $100 risked, we aim to make $300. Bullish example, gold USD on December 10th. Step 1. Confirm the trend using 12 EMA and 50 EMA, 15-minute chart. At around 3 a.m. New York time, we began by checking the trend on the 15-minute chart. The 12 EMA was above the 50 EMA, confirming a bullish trend. This indicated we should only look for buying opportunities, as trading with a trend increases the probability of success. Step 2. Identify fair value gaps, FVG, on the 4-hour chart. At around 3:30 a.m. New York time, we switched to the 4-hour chart to identify fair value gaps, FVGs. An FVG appeared, marking an area where price might retrace before continuing upward. FVGs act as magnets, drawing price to fill the gap. This allowed us to identify a strong liquidity zone where buyers could step in. Step 3. Analyze liquidity zones on the 1-hour or 15-minute chart. At around 4 a.m. New York time, we zoomed in on the 15-minute chart to observe how price interacted with the FVG. The FVG created a liquidity zone, and we waited for price to take out a short-term low. This is called a liquidity grab, where the market dips below a recent low, trapping sellers before reversing. Step 4. Use Williams Cent R to confirm oversold levels. At around 4 to 15 a.m. New York time, once liquidity was taken, we used the Williams Cent R indicator to confirm oversold conditions. The indicator dropped below Magna 80, signaling the price was in an oversold zone and could reverse upward. This confirmation strengthened our confidence in the setup. Step 5. Look for market structure shift on the 5-minute chart. At around 4:30 a.m. New York time, we moved to the 5-minute chart to find the ideal entry. A market structure shift occurred when price broke above a key resistance level. This confirmed that the bullish trend was resuming and presented the perfect opportunity to enter the trade. Step 6. Enter the trade and set a stop loss. At around 4:35 a.m. New York time, we entered the trade as soon as the market structure shifted. The stop loss was placed just below the most recent 5-minute swing low to minimize risk. Our target was a 1:3 risk-reward ratio, meaning for every $100 risked, we aimed to earn $300. Bearish example, USD CAD on November 21st at 3 a.m. Step 1. Confirm the trend using 12 EMA and 50 EMA 15-minute chart. Started by checking the trend on the 15-minute chart. The 12 EMA was below the 50 EMA, confirming a bearish trend. This meant we should only look for selling opportunities. Step 2. Identify fair value gaps, FVG, on the 4-hour chart. On the 4-hour chart, we found an FVG highlighting a zone where price was likely to pull back before continuing downward. Step 3. Analyze liquidity zones on the 1-hour or 15-minute chart. Zooming into the 15-minute chart, we observed price taking out a short-term high, trapping buyers. This liquidity grab is a strong signal that the market is preparing to reverse downward. Step 4. Use Williams Cent R to confirm overbought levels. To confirm the setup, we checked the Williams Cent R indicator. The indicator was above -20, signaling overbought conditions and a likely reversal down. Step 5. Look for market structure shift on the 5-minute chart. Switching to the 5-minute chart, we saw a market structure shift as price broke below a key support level. This confirmed that the bearish trend was resuming and it was time to enter the trade. Step 6. Enter the trade and set a stop loss. We entered the trade when the structure shifted, setting a stop loss just above the most recent swing high. The target was set at a 1:3 risk-reward ratio, aiming for a 3x profit relative to our risk. Conclusion. In my next video, I will be showing you the most powerful and profitable liquidity raid pattern based on Larry Williams' Setup 3. This strategy combines the power of the 12 and 50 EMA, the accuracy of the Williams Cent R, and the precision of the fair value gap to give you a solid edge in the market. Stick to these rules, practice consistency, and you'll be on your way to profitable day trading in 2025. Like, subscribe, share. God bless. Happy trading.